All right. Good morning, everybody. So today we have the opportunity for a liquidity gap close play, and the markets are waiting on this. There's really nothing else to focus on until we get this, meaning we don't want to really spend too much time looking at the gapped up stocks. We don't want to get embedded with any bias for one direction or the other. We need this data print to come out. We need to see if it's going to present a gap close opportunity or not, and then we'll evaluate everything else after that. So, the way I do the morning briefing, it's always been designed to teach you how to prepare for the trading day, and then you can adapt it to suit your own needs because maybe you don't trade what I trade or you don't trade it how I trade it. And so I'm not trying to give you a fish every day. I'm trying to teach you how to fish. What I would recommend is after we get this data this morning and we get closer to 9, maybe 9:15, go in and do the steps that I normally do, that I show you every day. Looking at the stocks that are gapped up, what sectors they're in, and then try to get a feel for what the day is going to bring. We're going to focus on this gap close play. And I'm going to show you some examples of what we're looking for and then give you some examples on what we are not looking for. It is worth noting on this PCE data, the market's expectation. And if we come in on one side or the other, it's going to shock the market, right? The market is going to be off sides, and then we're going to see bigger moves. They are hedging, and we'll show that too. And there is some Fed speakers in the later part of the day. So while the PCE is the biggest thing on the table today, there is also more data in the afternoon. You can see Williams, and then we're going to get more out of the Bank of England today. And then we have Bosick really later tonight. That won't be a problem. One of the things that you're going to want to keep your eye on when we get this data is the dollar and the 2-year. If you watch Finance Juice on a day-to-day basis, when something is market moving or potentially market moving, like this uh, PCE data, this is the setup. This is the chart that they'll show when the event came out and then what move we got from it. So I didn't put this 3 grid chart together myself. I've seen it on Finance Juice often enough that when it comes to events, this is the setup that I like. Yeah, you can build this on your own. It's nothing to it, right? 3 grid at the top. I use the 2-year on the right, the dollar on the left, and the ES in the middle. Now you could swap the ES for the SPY. You could use the QQQ or the NQ. You want your index on here. You want the 2-year and you want the dollar in whatever order you want. I like the lines for the dollar and the 2-year, and even sometimes I'll put the index itself into a line chart or an area chart, just because when you're kind of zoomed out as I am here, the candles become a little indistinguishable and the lines are often just easier to read. But if you have moving averages on there, then it can get a little muddy between what's the moving average and what's the market. So it's just user preference. I got it set to a 2-minute. It's what I'm comfortable with. Most of my market tools like Tick, Trend, AD, UVol, DVol, Weighted AD, CTick, I tend to run those on a 2-minute time frame. It's not what I'm trading on. It's not my trading chart. It's just the tools that I have, and I set them to a 2-minute. As far as I'm concerned, this 2-year and this dollar is my tools. They are my indicators that I'm looking at. So that's what we want to be watching for. And if you watch Finance Juice, you're going to see that same 3 grid. Very likely they're going to post it today. You don't need an account at Finance Juice, although I recommend you getting one, even a free one. It's free. It's not going to cost you anything. build a free account here so that you can use the filter and eliminate the trash that you don't want to see. Finance Juice is a news aggregate website. They're going to aggregate data from all over the place. I don't know your preferences, but I don't really give a dang about CNN and MSNBC and Fox Business News, right? I don't want that. So I cut it out. If you have an account here, even a free one, you can cut that noise out and then you don't see that trash, right? Just eliminate it. I have a paid account because it's not very expensive and I think it's worth it. Paid accounts let you use the squawk, and that audio is nice so that I don't have to sit there and look at this thing all day long. And a lot of the things that you see posted in here are often squawked first, often by 30 seconds to an entire minute ahead of what gets posted. And then there's things that they have in the voice news that never get posted here at all. So I like it. It's useful, but if you're not using this at all, really consider it. It's good on the mobile app too. I often have it on my iPad. However you want to do it. It doesn't cost you anything. So let's talk about this gap close play so that you'll understand what we're going to be focused on here. Now, I talk about this on CPI day or PPI day, but really it's anytime we expect a big move in the market. We're looking for this very large leg out candle. So this picture was very likely a CPI day, but it doesn't matter. It's an 830 print. It can go up or down. I don't care which direction it goes, but we don't want really any wick at the start of that 830 print. And we want the market to close near the other side of the candle. We don't want it pulling back towards the middle of the candle or even all the way back to where the candle opened. So not a lot of wick on the closing side and nearly no wick where it opened. After we get the initial move, the leg out, we want to see some sort of reversal pattern. We won't always get that, but most of the time it'll start to perform a little bit of a base, and then we'll come back and get that gap closed. We're trying to get back to where we started at 830. And I get it. You see a candle here. You're not seeing a gap. So why do we call it a gap close? It's a liquidity gap. Thinking about the order flow and the lack of orders, the lack of structure, right? The weak ceilings that we left behind. This is a liquidity gap, and that gap wants to fill. So even though we had a bearish move, once we got into the open, we looked to get that gap closed. It didn't necessarily mean that we were bullish. We weren't necessarily expecting, a continuation to the upside per se. We would need to get the gap closed first and then evaluate, is this going to lead to a bullish afternoon or not? We got the gap closed around 11 a.m. I often say, watch the clock. And I mean that. There's no subtle hidden meaning into what I'm saying. I'm literally telling you, look at your watch, look at your clock. What time is it? Markets move on time. Economic data, the close of a market, the open of a market. There's news events and speakers. Nearly everything happens on a new hour or a new half hour, sometimes even on a new 15-minute candle. Watch the clock. Here's another gap close play. Almost no wick at the start of the move. Not a lot of wick on the closing side of the move. We didn't really base here. We didn't get much of a reversal pattern per se, but we already had the bias that we were going to focus on closing the gap. The market got the gap closed, came back to where we started, and we got there around 11 o'clock. A little early, about 10:30, but around 11, 10:30, 11. So another example, this one was CPI because I put it in there to remind myself. Move to the upside. Notice that there's multiple candles on this one. The first initial drive closed greater than 50%. If we think about, the midpoint to this candle, it closed in the upper portion. And I would say it closed even higher than the 75%, right? If we were to break this candle into 4 pieces, like 4 quarters for $1, then we closed in the last upper area. The next candle maintained that range within the wick of the first candle, and then we continued on even higher. That one also closed in the upper portion. It left a little wick behind, but it still closed more bullish than bearish, and then one more candle after that. So this one took a while. There was a lot of drive there, but then we still ended up building a basing pattern, putting in a topping pattern, rolled over, and worked on getting that gap closed. We got there around 11 o'clock. A little early, but we got there around 11 o'clock. Notice the bullish bias is gone, and yet we weren't bearish either. We got back to the starting point, overshot it a little bit, and then came right back in again. By the end of the day, we were up, sure, because the data print happened at 41.72. We closed at 41.98. So there was a little bullishness there, but it wasn't this wow exploding move that just kept going and going and going. Now, I do want to warn that that can happen. We can get the setup. We can get this really beautiful candle where it runs up to the top and it looks like the perfect liquidity gap close play. And then we fade a little bit, maybe stop at the halfback. And then it just continues to the upside. So it does not have to gap close, even if we get a perfect gap close setup. The key is going to be that 50% mark. And you can see that's where this one got hung up a little bit. It's almost like if it was going to turn, it was going to do it there, right? But they failed to get it turned. So it was just a nice little pullback and then a continuation, and we got that gap closed. So even if everything looks perfect, there's still no guarantee that we're going to get the gap close. But I have found that this gap close setup, even knowing that it exists, even if you don't want to trade it, knowing that the strategy exists can at the very least temper your expectations of a continuation of the bullish move or the bearish move, whatever we get at 8:30, because that's what I found a lot of traders who are newer to trading get hung up on. The print looks very bullish. It looks like we're going to continue for the day. They go long, while me and everybody else that I've shown this to is shorting that sucker back down to where it started. So, even if you don't trade the gap close, at the very least, I'm hoping you won't try to trade the continuation if it's presenting every signal that it's going to close that gap. Now, this is what we don't want here. I marked out the halfback already, showing how price closed very close to the midpoint, left this very large wick behind up here. And sure, it did come down and it did close the gap, but it ran the entire thing back to the gap close before the market even opened. What happened to 11 o'clock? That was off the table. And this just moved very fast back down to close the gap. I don't generally trade between that 8:30 and 9:30 time frame, or between 8:30 and even 10 o'clock time frame. There's just, for me, I have no interest in it. So sure, this did gap close, but that very large wick structure up here like this, and then the immediate attempt to close the gap, even having that first candle close near the 50% mark, it's not what I would want. Also, that's a cog line, 50.33 or 50.32, take your pick. It's that zone. So not being able to hold structure above that cog line, which was also the halfback, and falling back down, this entire thing is just a great example of what we don't want. Here's another example of what we don't want. If we see this, there is no gap close play. We're done. There wouldn't be one. Big wicks on each side, market closing nearly where it started. If that's what we get, there is no gap close play. Now, don't mistake that to mean that I won't trade. There's still always something else to trade, or wait for later in the day to find a trade somewhere else is not a problem. I just wouldn't be focused on getting a gap close. Same thing here, another example. Big wicks in each direction, very large candle, a lot of movement, but we closed really close to where we started, and there is no gap close play here. as far as I'm concerned. Now, you could argue that, sure, in the very next candle, we came right down and we closed that gap. I mean, if you're scalping and that suits you, hey, you do you. But this is not what I'm looking for. These are examples that would invalidate the move. And it also invalidates our bias. Earlier, I had mentioned it could be as bullish as it wants to. It can look very bullish. It can look very bearish. It can close at the high of that candle, and I would still be looking for a reversal. I'm still looking for the gap close. But if it does this, big wicks on each side, then I no longer have that reversal bias. We could begin to expand. All we have to do is break the range of that candle, and we would be able to expand and really, have a bias for a continuation to one side or the other. Now, here's an example of a liquidity gap in the intraday. These don't just happen in the pre-market. They happen all the time, all over the place, and they can be different sizes. In this one, we had the 10 o'clock news that drove us to the upside. Almost no wick down here at the bottom. Closed near the high. Little bit of weakness in the structure, but if we measured 50%, it stayed above the halfback. We had another one here where we dropped out really fast on 12:30 news. This one was immediately, we ran right back up and closed the gap. Then we had another one here where we dropped down and got the original gap closed and ran right back up again and got that one closed. That was a crazy day. We can get them all over the place, right? There's so many different ways that you can approach this from an analysis standpoint, from a trading standpoint. You can apply technical analysis to the gap candle, put your quad lines on it and measure the market measured moves higher and lower. We topped out on the 50% of the measured move of this very large gap close candle. Same thing to the downside. If we had measured this candle and projected it to the downside, our 50% move would have put us somewhere around this gap close range. So works out really nice. We can do technical analysis, quad lines, measured moves, all based on the very large candle, that one single candle. And if you use footprint charts, you can put the point of control per candle on and evaluate where the greatest amount of volume was in that one single candle as well. So that's what we're looking for, a liquidity gap play. And now that I'm not zoomed in really tight, you can see how a lot of these worked out. Keep in mind also that they can be on different markets. So the ES and the NASDAQ can both get one. And then maybe one closes the gap and the other one doesn't. On one of these failed ones, the ES didn't get a really good gap close play set up, but the NASDAQ did that day. So, if you're nimble and willing to trade different markets, look for opportunity on another index. All right, so we were talking about the distance from the weekly pivot point the other day. And we've had this move this morning where we've drawn farther away from the weekly pivot. That's the purple line that we're seeing here is the weekly pivot. So I went in and I measured a couple of different weeks, especially ones where we really expanded. Here is a week where we went 4.5% away from the weekly expected move, or from the weekly pivot point. But a lot of these are around 2.5, maybe closer to 2.25. And that's as far as we got before we flipped over and went back the other way. Here's 2.75, another 2.5. So far this week, we're not even to 2%. So have we moved too far too fast and gone too far away from the floor pivot to the downside? Does it owe us a pause or a mean reversion? Not from this location. No, we could still move another 0.5% lower, and that would still put us at around 2.25 to the downside away from that floor pivot. And the average seems to be around 2.25 to 2.75, with some outliers, that 4.5 move back here. So if we're not even 2% away from that, then I would say we still have plenty of room to the downside before we would start looking for any sort of a pause or mean reversion back in the other direction. The purple line here is a daily floor pivot. Channel around it is the CPR, central pivot range. The pivot is lower than yesterday's pivot. The entire channel is outside the previous day's channel. Price opened underneath it, which is also bearish. And yesterday we had what we call an MDP. That's a missed daily pivot. That's another strategy that I learned, and I'm appreciative for having learned it, although I don't trade it. I don't trade a missed daily pivot strategy, but knowing about the strategy, having learned about the strategy, gave me more insight about how to use pivot points in my analysis. So if you don't know the missed daily pivot strategy and you're a day trader, heck, even a swing trader can use that. It's worth looking into. It's not my strategy to teach. You can just hit YouTube and type in missed daily pivots and you'll find a strategy. And it's good for swing traders, day traders, really just about anybody out there can find value in it. I don't trade it, but it does provide context. So yesterday we had an MDP. So far this morning we have an MDP, but today doesn't count yet because it's not done yet. And we could very easily just run up there and hit that pivot point. Price hits its pivot point more than 80% of the time. So when we had a day where we didn't hit it, we were doing something unusual. We were doing the 20%, right? We're doing the thing that we don't normally do. That should stand out. We've also been flirting with this S1 all morning. We got a little bit lower than the previous low, which is a perfect bear trap. I caught that this morning. That was a nice trade. Think about it from a double bottom standpoint. If this is the low that we're focused on, price makes this double bottom. Double bottoms are bear traps, but it needs to be convincing, right? If it's not convincing, then it's not going to trap any bears. So if it was just to come down and tag that line perfectly, that would not be a very convincing bear trap. What bear would want to short it if we haven't even broke through the previous pivot yet? So double bottoms and double tops, they need to break the previous pivot. Once we do break it, we got a measured move. We should tangle up around the 111, maybe the 1236, and then flip it and run the other direction and squeeze those bears really fast, make them buy to close, which adds to the buying, which gives us a very nice leg up. That reversal candle, the stronger this candle is on the reversal, the better the trap worked. We don't want a lazy, slow grind back up because that doesn't show trapped bears either, right? We want to show an immediate, fast reversal back in the other direction. And we want to see their pain, see them struggling to get out. Their buying adds to the buying. We get that really sudden, sharp push the other direction. So we've had the classic bear trap. We're back up through the midpoint of this range. And there's really nothing else to do with this range until we get our data this morning. There's no reason to lay out quad lines and levels on this zone. The data candle that we're going to get at 8:30, we can do all of our analysis on that one candle after we get it, right? And I use a 5-minute candle when I'm doing candle analysis like that. If it wasn't a day where we're going to get econ, then we would take this range from the Globex high to the Globex low before the breakdown, and we can project those levels in each direction. Now we've got our upside and downside levels. We could also just do the entire range if we wanted to, from the highest point to the lowest point. There's nothing wrong with that either. I would just rather use the original low, not the new low, since the new low was a part of the bear trap, but either one would work. Using that as your level, actually it's way up here, from the highest point of the Globex to the lowest point, and then projecting these 50%, 100%, 150s, 200s in both directions. That would give you your layout for the day as well. Right now, we're still inside day breakout, and the Globex has shown us a lot of structure at this low from yesterday, this Globex low. It wasn't yesterday's low. It was just yesterday's Globex low, and it was also the S1 level. So we built structure there. When we go to the volume profile, we're going to see that, right? And yep, I haven't got there yet, but also there's a voodoo line here, forest. So we'll see that when we get to the other page. But we don't want to do this grid on the Globex range this morning because we're going to get this data print, right? So I'm only showing what we would do if we didn't have 830 econ coming up. We would use the entirety of this range, lay it out, and plot the levels in both directions, and then also consider any pivots from yesterday that would be of importance, which this Globex low would be one of those pivots of importance, right? Typical support and resistance with pivot points and measured moves. When we come into the Globex and fade down to an S1 that holds as support, we look for a cross through the pivot point and into an R1 or an R2 move on the day. That's what the expectation is. Even that's what we expected yesterday. But we knew we weren't going to get it when we never got back inside that channel, when we weren't even able to get to the channel, let alone get into the channel or get to that pivot point. But generally, getting to that S1 before the open and then starting the rally up is like the starting point for getting to the pivot and then the R1 and the R2. The only thing that added to that bias was that yesterday we had no expectation of a market move, that we were going to hold the line and go sideways. Well, that's exactly what we did. We stayed inside of our own Globex range until the very late part of the day and then fell out there towards the end. But that would have been the late part anyways. I wouldn't be trading in there. The expectation for that sideways day, that's not the expectation for today. Now, one of the reasons for that expectation is this narrower channel. It's not as narrow as I would like it. That channel can be so narrow that you don't even see the channel. It would just be buried underneath that purple line. It would be a channel so narrow that there isn't even a channel showing. So when I say that it can be narrow, I mean it can be very, very narrow. The more narrow this channel, the more bias we have for a breakout, a trend day, an expansion day. This was a narrow channel day, and you can see the outcome. Now, this narrow channel did not cause this big move. And I want to really, pound the table on this. These pivot points don't make the market do anything. So a wide channel day, we expect a sideways market. A very narrow channel day, we expect a market that can trend or expand or really break out and move. But these pivots are not causing that move. We have an expectation that even though it's a Friday, we can move today. We can have one of those breakout move days. One, because we have a relatively narrow channel. Two, because of the data that we've gotten this week, or the lack of data. I'm gonna the founder's note just came out for spot gamma. I'll get that shared with you guys. We'll see if they have any insight on what can happen today. They'll usually have something really good about the options levels, and if there were any levels that rolled up or rolled down or were just erased. So I'll get that shared out. You can't. I can just share the indicator. I've shared it multiple times. It's in the Thinkorswim workbook. And if you can't find it in the Thinkorswim workbook, then I'll just put it in the, I'll just share it, right? We'll just copy the code, put it in a text document, and I will put it in the chat. Then you just have to import the code, right? All right, I just shared Spot Gamma's founder's note. So that's the AM version. If you're on TradingView, you can search for these, by the way. And I don't code on TradingView very well. I can adapt somebody else's code that's already there, but I can't build an indicator from scratch on TradingView. I'm just not good enough to do that. On Thinkorswim, I can code whatever I want. But so if you're on TradingView, just search for CPR, Central Pivot Range. You might find a Thinkorswim version online. Just go into Google and typing in Thinkorswim CPR. But I have the code, right? If you want the one that looks like mine. I built mine where these lines get thicker. So this is R1, R2, R3, S1, S2, S3. Each progressive level gets thicker and thicker and thicker. And then the channel changes color. If it was a bullish channel, then it's this light gray. And if it's a bearish channel, then it's this deep dark red. I like it. I tried to keep it as minimalist as possible. And then, of course, if you open up the code, it does have the time in the upper left as well. So you can hide the time. You can show high-low close from yesterday if you want to, show the midpoint. And then, of course, you can hide the channel and you can hide the clouds. So that if the clouds are annoying you after the day is already opened, you know, say it's a wide one and price keeps cutting through the middle of that cloud, that's very annoying. I just turn the cloud off, right? That way for the rest of the day, it's not all in my face, distracting me and causing me grief. Let me know if you don't find that indicator in the Thinkorswim workbook, and I will share the code in the chat. We can see a little bit of a discrepancy this morning. We have a lot of volume, and they're hedging. Normally, we would see hedging with low volume, or we would see high volume and no hedging. It's very unusual to have both high volume and hedging. We have the zero gamma over our head, that's ZG. We have the volatility trigger over our head, that's the VT. The 10-day moving average, the 3-week moving average, and the 20-day moving average, all over our head, and the central pivot range, the floor pivot. Then we have our ADR levels. Now, we're flat on the morning. We haven't done anything. We're at 0.09 to the downside. That's basically flat. They're hedging because they're concerned. Now, this isn't my opinion. I'm not guessing or assuming that they're hedging. This is fact. This is like, you know, the sun comes up and goes down every night. That's fact. There's no disputing this. If you don't have Thinkorswim with a market maker move, you can still see if they're hedging or not. On Thinkorswim, it's right here. That's the MMM market maker move. And what it's looking at is the front contract, the 0-day contract, versus the next contract out in the average implied volatility. If the average implied volatility in the front is higher than the next one out, they call it a market maker move. How far those two are apart is the way that this is quantified for the size of the market maker move. Now, because we're looking at the futures product, it still has that -1 from yesterday. It says Thursday on it. So if we just ignore that for a moment, there's our 13, which is greater than 9. That's why we have a market maker move this morning. We know that they're hedging because of this. The way that this number is derived, like how do they get this number? They take all of the out of the money options on the put side and all of the out of the money options on the call side, the implied volatility values. They add all those together and then divide by however many they are, right? That's where the average comes from. Well, when the firms are hedging, they are trading the out of the money options. We can see that. There's the volume for today. There's 7,000 here, 3.25. They're hedging in here this morning. Same thing on the call side, 3,000, 2,000, another 2,000. That trading activity this morning is them hedging their positions. And because they're trading these out of the money options, it's changing the implied volatility values around those levels. And that gives us an increased implied volatility average and rises it farther than the next series out, which gives us the market maker move. If you want to learn more about the market maker move, it's a TD Ameritrade thing that was developed years ago by Tom Sosnoff and Don Kaufman and all those guys, right? That was the whole gang back in the day kind of came up with this. But you can read this publication called The Ticker Tape, which is an old publication by TD Ameritrade. On that website, you can just search market maker move and you'll find a good 30, 40 articles that discuss it in various ways and kind of lay it out there. Interesting enough, in all of those articles, they never talk about using it on the futures. I don't know why, but to me, this is an excellent tool to see if they're hedging in the futures. The articles all talk about big events like earnings and new drug trials, maybe a lawsuit, CEO getting sued, those sort of things that can change, and give us a market maker move. But I use it on the futures. To me, it's a perfect way to see if they're hedging right before an event like CPI or PCE. So we know they're hedging this morning, but they're also trading this morning. It's very likely the trading is from the data we were getting out of Europe, and then the hedging is because, well, we're about to get data in 20 minutes. All right, so we've expanded this profile to the downside. This is a 10-day, 30-minute volume profile. We haven't really built out any structure yet, and the profile still has more of a classic P shape than anything else. The P shape profile is considered a bullish profile, but you have to take that with a grain of salt because most of the profile books will talk about how a P shape profile was built. They'll usually talk about price staying in a range like this, and then it drops down and comes back up. Or the books will talk about a market that was moving to the upside and it paused and chopped. And that little leg right there is where they get the P shape. So in the books, laying out that bullish bias to get this P shape, both of the scenarios were a bullish market. But what about if we were just a market that was chopping and chopping and chopping, and then finally we fell out a bit? That would also give us that P-shaped profile, but that doesn't sound very bullish at all. That's a bearish bias. It'd be having a market that was moving to the downside and then it chopped and then it continued moving to the downside. That would show up as a P-shaped profile. So the books say that this is a bullish profile that still needs price to come back up. If we focus on a failed flag play, then the 786 becomes the level that price needs to get through to come back up from that other direction. If it's going to be a failed flag play, then after price comes down here in bases and the base is too long, which is one of the hints that the flag is failing, then we would then come back up, break the 786, and begin this whole rounding structure, which would give us a cup. We would trend back up through the other side and have the shape of the cup afterwards. For right now, though, we just got to get through that 5250. That's a significant line in the sand. If the data is good, we're going to cut right through that thing like it's not even there. We'll move to the upside and we'll begin this entire cup process. Otherwise, if the data is not good, we're just going to continue expanding this profile to the downside. We're still not expecting this point of control to move until maybe half of next week, right? We would have to come back into like 5,300, build this high volume node out, and then bring that point of control down. I don't see that happening. I don't see us holding in that zone right at 5,300 long enough to bring the profile down to this level. So as the week goes by, next week, we're going to lose a lot of this volume that gave us the profile at that location. And it very likely will default down to here if we don't build a high volume node somewhere else. So by the end of next week, 5290 area is where we'll be looking for the new point of control. We took out that VPOC from yesterday, 5247, right at the very end of the day, and it cut through it like it wasn't even there. But it was, near the end of the day data, really violent flows anyways. Not a surprise that the VPOC really didn't offer any help. We almost hit this one down on the bottom, this 52.30.25, but almost doesn't count. And yesterday we got a new VPOC, 52.67. We're still outside the box for the week. And we're already looking at next week's box. Now, one thing about this, the box isn't set in stone until tonight at 4:15 or later. So through the day today, you're going to see this box move up and down, and the range of the box can get wider or more narrow than it is right now. So we can see next week's got a lot of volatility priced into it. That range is much greater than the current week's range that we have right now. By the end of the day, it may be more narrow than this. We don't know. But when we look at it Monday, we'll, of course, come in and do the same thing. We'll draw a box on our current week and we'll put it on the new week. And we'll see how much wider or less wide the range is next week. But right now, looking at it, they're pricing a lot of volatility in for next week. We're underneath the 10-day, but not too far. If we were looking for a reversal because of how far we have moved, we haven't moved far enough to trigger that, right? Being able to ask that question, have we moved too far, too fast? And does it owe us a reversal or a mean reversion? Not on the daily. And looking at the weekly, not on the weekly. We're not overbought. We're not overextended. We're not oversold. It doesn't owe us a mean reversion move. We have less than 15 minutes before the data comes out. You could look at the market watch in these quotes, but honestly, it's always a waste. I've tried wasting my time going in here and evaluating what's up or what's down before a big data print like this. And then the data comes in and just, it's like shaking the Etch-a-Sketch and taking us right back to the start. So don't waste your time looking at what's up or what's down. Let the data come in, get that first move, see if it sets up as a gap close or not. Then look at what is up or what is down. Now, you're always going to get some things that don't care about the data print. That's things like earnings. So if something reported today and it's bullish or it's bearish, it's going to ignore whatever data we get. If something is in a short squeeze, same thing. It's going to move no matter what kind of data we get. So there's ways to sidestep the impact of these events. But for the most part, if you're trying to day trade and you're looking at the equities and things that are moving, let's get the data print first. And then sometime around 9 or 9:15, you can go in and look at what's up and what's down and try to gauge the sectors and what's moving at that point. I want to leave you with this concept. It's a Friday after a short week. We would generally expect a market to hold the line and go into the close with a whimper. Nice and quiet, no big moves. I'm not so sure we're going to get that. Every once in a while, they like to throw something at us where on a day when we don't have any expectation of a market to go sideways or a market to move, we actually do start to move. So with that in mind, the base case argument is it's Friday. We have no reason to believe that we're going to do anything more than hold the range, and that we very likely are going to just stay in the box that I just drew. That's yesterday's RTH high to our own Globex low from this morning. And even if with the data that we're going to get, we could wick out of this box, but that we very likely come back into it and we just hold the line, hold the range. If we get out of this box, it's game on, right? If we expand out of the bottom and don't just immediately come right back in again, start to expand to the downside, then we'll focus on the S2 and the S3 levels. We've also got the ADR levels at the ADR half and at the ADR full. You've got the round number 5,200 and then 5,150 if we get through this S3 down here. To the other side, if we were to go to the upside, we got the ADR half, R1, R2, which is the full ADR, and then R3. And you've got 5,350 if we do continue with that bullishness. Now, you might be looking at this and saying, come on, man, you're reaching. That's 100 points away. 100 points is nothing. We've got an ADR right now of 0.85%. That's 44 points. We've got a market maker move of another 0.45. It's another 23 points. So call this 45 and 23. That's just your typical move. That's your, just another day at the office. What if the market actually wants to do something today? Then it would double that number. It would double the entire thing. So we could easily get to 53.50 or 51.50, no problem. That's not the base case argument. The base case argument is we're going to stay in this box that I just drew. But if we do start to expand, then we have our levels level by level, both directions, no problem. With that sideways expectation, we could end up with a day that looks a lot like yesterday, where we just chop about and we don't really do anything. Even with this expected big move for the data print here in about 8 minutes, if they hedge it enough, we won't really even make a big move at all because it's hedged so much. Nobody's offsides. There is no offside. If it goes up, they're safe. If they go down, they're safe. They're not going to be caught by surprise. Nobody will be scrambling to all sell at once or all buy at once. It's surprises that moves the market. When they have time to prepare, they'll just hedge the heck out of it, and then there is no threat. So, base case argument, we're just going to chill into the weekend, but be prepared for the other thing. It is worth noting, just get these out of the way real quick. These are the voodoo lines. That solid green line there is forest. You can see the market responds to forest well. It struggled before it finally got through there. Once it did get through there, it responded well to it on the other side before it broke underneath it. And then again, when it ran up into it after having left the range. Now, that's unusual because typically the more you interact with a pivot, the less structure that pivot has. But the more you interact with a pivot, the more volume you leave behind too. That can lead to volume profiles, points of control, all kinds of things. So this voodoo line forest, this has a lot of structure behind it. It's got some history to it. And we're fighting with that level right now. It's also worth noting the moving averages. For the daily on the SPY, we cut underneath that 20-period moving average yesterday. Closed underneath it. Now we're struggling to get back above it. We're underneath both of the two major moving averages, the 10 and the 20. If we were wanting to read this like we were reading a book, then we have bullish strength with a bullish trend, but the trend is fading, and we have an increased bearish momentum, and we have bearish surge. The surge is from the 310. The momentum is from the 1020. The trend is from the 2050, and the strength is from the 5200. So we still have our bullish strength and we still have the bullish trend, but the trend is fading and the bearish momentum is increasing. So this needs to turn around and start moving back the other direction. But we might not get that turnaround until we can bounce on 5200, which is the 50-period moving average. We might need that bounce first before we can get back up there. There are examples where we've cut under the 20-period completely, closed underneath it and everything, and then rallied right back up through it and continued our move to the upside. So just being underneath the 20 for one day isn't enough to turn us all bearish and, have us looking at 5,000. You guys got a few minutes before the event. Be careful, be safe, have a good weekend, and I will see you